are so many moving parts in retirement, it takes a true expert to help you determine how to best provide a wealth benefit. The problem for most is that the advice that we have comes from fragmented sources that lack the required comprehensive perspective. The two most common sources of experts would be financial advisors and CPAs. And let me explain the challenges brought by these independent thinkers. We could look to our typical financial advisor, wealth manager, or financial planner to consult with on these matters. For those true advisors that go just beyond investing for you, the good ones are supposed to be long-term strategic thinkers with the primary goal to help you make smart money decisions over the long haul. That's the benefit this class of advisors should bring to the table. However, it's fairly rare to find one that could also claim and truly demonstrate to be a tax expert that applies that tax expertise on a long-term strategic plan. My name is David, and I started in financial services in 1980. I happen to be a registered financial consultant, a financial planner, an accredited investment fiduciary, but I'm also an enrolled agent with the IRS. As a planner for tax plans for wealth, when we do our plans, we do not use inadequate financial planning software. Rather, we use tax software that can calculate your income tax burden over multiple decades. With my nearly 40 years of experience in financial services, I'm yet to find a financial planning software in widespread use that accurately calculates taxes, or that can create a strategically blended cash flow distribution or retirement income stream created with tax mitigation in mind. While these advisors may often be well-intentioned, they typically lack the proper understanding and tools to provide a long-term tax plan. Additionally, fee-based advisors have an inherent conflict of interest. I like to explain that with our IRAs and 401ks, we don't really own everything in those accounts. We get to invest everything in our accounts, and our advisors that are fee-based get paid on the entirety of those accounts. But we really have the equivalent of a mortgage on those assets, a debt obligation to the IRS. And as our account grows, so does this debt obligation or mortgage. There are many occasions when prepaying a portion of that mortgage, or even the entirety of that mortgage via a Roth conversion strategy, can provide a great long-term benefit to your wealth by transferring the monies into investment accounts where the growth will never be subject to erosion from taxation again. Initially, when you pay down this mortgage, from my perspective, your net wealth stays relatively the same. But your investable assets, what your advisor gets paid on, that goes down, and that creates a conflict of interest. Some advisors are indeed suggesting Roth conversions, but they're doing so because it's the in thing to do, without a true understanding of the inner workings of all things tax. That might be akin to you walking into a doctor's office with a stomachache, and with no questioning or examination, the doctor hands you a bottle of Tums. Truly be cautious of where you get your tax advice from.